While most contract development and manufacturing organization businesses and companies have outshined recently, Hikal Pharma stock has been a laggard so far. Now, in our Ideas for Profit today, we'll discuss what gives us conviction for the long term in this stock. Well, first, a brief on the quarterly performance as well. Now, if you look at the Q1 FY21 earnings, the revenue slumped by 12%, and that's on a year-on-year basis. And that was chiefly on account of 30% degrowth in the crop protection business, which constitutes 39% of the total sales. Also, pharma business, which constitutes 61% of total sales, was largely steady with 5% growth and partially aided by the new capacity as well. Now, the crop protection business was impacted due to several headwinds here, and that was faced by the global customers, leading to deferment of the volume of take as well. Also, restrictions imposed by the Maharashtra state government, that is something that we needed to watch out for. That impacted the operations for crop protection plants at Mahad and Taloja, leading to further curtailment of also sales this time. Now, though the company witnessed improved gross margins, the EBITDA operational performance was impacted due to the adverse operating leverage and a COVID expense of say 4.7 crore rupees, and that was towards the employee benefits and the other additional cost incurred to mitigate the impact of the pandemic on the company's performance. Now, adjusting for the EBITDA margin was 16.2% of the quarter gone by. Also, company's capex program worth 300 crore rupees has been delayed due to the pandemic and now is expected to be commissioned by Q1 of FY22. Now, company's leverage ratio, or the debt to equity ratio as we talk about, has moderated from 0.8 times to 0.68 times in the last 1 year, leading to reduced interest expense in the quarter gone by. So that's a little bit of a positive we are tracking right now. Now, coming to the key risk factors, the concentration risk of products needs a close watch going forward. Both the pharma as well as the crop protection segments have a product each with a high share of revenue, say 15 to 40% of the segmental revenue. That needs a close watch. Here, the traction for the API used for the neuropathic ailment gabapentin, for which Hikal is one of the leading players in the domestic markets, is a key watch. Interestingly, India imports nearly 90% of the total gabapentin demand, and that's from China. So any kind of protectionist measure from the government, given the recent trend towards anti-dumping duty and Make in India theme, could disproportionately benefit the company going forward from here. Now, overall, an interesting or an inherent aspect to evaluate businesses in this sector is how the companies are really investing behind the managing of operational and the regulatory risk. Now, this is where we like the efforts of Hikal's management. Now, here investors should note that it currently procures about 35% of the raw materials from China. So that is again a key factor to be on the watch list. However, given the sourcing risk, Hikal had started to execute the sourcing de-risk plan and backward integration initiatives as well, which may help it in the longer run. Now, further on the operational efficiency front, Hikal has reduced the operational costs for 2 of the major APIs during the last fiscal year and targets to replicate the cost savings for the other APIs as well. And now, additionally, in order to be environmentally compliant, the company is also making substantial capital investments to upgrade the ETP, or the effluent treatment plant infrastructure as well. Now, among the future earnings catalysts are the Japan opportunity, where the company really expects a significant order to execute in FY21, and there's also a growing animal health business. So these are the triggers that can provide growth in the coming times. Coming to valuation, the stock is currently trading at a reasonable multiple of 7.2 times EV to EBITDA, FY22 estimated earnings. So that's something that you need to see in a positive light, which is compared to its peer CDMO business or the end market player in the pharma or agrochemicals and the animal healthcare industries as well. Now, we do believe that this global cost leader in several key APIs should be on investors' radar for multiple growth catalysts that we have talked about.